Okay, here's going to be our learning objective. Complete the 12 T's of trading format for a layout of a model. Make a simple model to hedge portfolios. Understand the sizing spreadsheet. Understand the mental aspect of sizing, and understand how a loss in a row affects the systems. How losses in a row affect the system. Now, here's our vocabulary list. We added a few things in here. They're very simple that you should be able to go over. And the only thing that's kind of tricky, we talked about time slice data right here. This has to do with trade sizing, so I have to bring it up. Sizing, basically, the purpose of sizing is how far does the damn thing go? Well, the previous 20 bars have nothing really to do with what's going to happen on the next 20 bars around 7:30 or 6:30 in the morning. A news event's got more to do with it. We construct our indicators at those times of day slightly differently. This is just a highlight of it. Now, the goals of some of the things that we're going to need to capture over the next few weeks is how many losses in a row could I take? How long does it take to win? How far does it move? And what happens next, the resistance zone or the S zone? Now, I added a couple new topics down here. Trade sizing, this is a big one. I didn't get a chance to finish it. The goal is to balance your real need for money versus your real concern about loss. Well, how do we size? We're going to size the losses in a row, but we need to know how far the damn things move. So there's several different techniques to do this. We're just trying to gauge historical volatility. We take resistance minus support. So R1 minus S1 equals current volatility. Or another way to say that is I'm going to pop up something right here. Resistance minus support, or this block is current volatility. Okay, that's just tells you how far it's moving right now. All right, that's just one method to gauge volatility. Okay, this is our spreadsheet. We're going to be using it in just 30 seconds. Okay, I want to go back to our Google document, and I forgot it was in Google and not on my Open Office. All right, so another way to gauge it is from the top of a Bollinger Band to a bottom. Well, a top of a Bollinger Band would gauge you volatility. You would just pull on a Bollinger Band and you'd say, well, whatever the distance between the bands is, that's a 20-period standard deviation. Top of the band to the bottom of the band is an expression of volatility. Okay, we need to figure out how far it moves. Now, there's lots of techniques to do this, and they're all pretty damn close. One of those is one I developed that's been written up in a magazine. It's to do this. You take and you say, well, what is the average number of bars between this point, the average number of bars between this point, the average number of bars between this point? Okay. This would give us how far we think it moves. So we might average in the number of bars here to the number of bars here to give us an average move up. All right, we take those ranges and gauge it. That's called, we call it a pay day and a pay range. A pay days are the number of days on average between there, and a pay range is the height. So the days is the width of this. This would be your average between these. How many bars were from S to R? How many bars from S to R? How many bars from this I to R? That's how many bars. That's your pay days. Your pay range is the height. It's the height. So when we're calculating out volatility, we're really saying we want P over T. We're really trying to calculate out price over time. That's what historical volatility is. Another way to do this is to go back through full data sampling, cycle back through all the data. When you do that, though, the stocks have moved, so you have to adjust it. You might take the range of the bar you're looking at from high to low and divide it into the close to give you a percentage. You may take where we are in the range, and determine what part of a range we're in, a percentage. There's lots of different ways to calculate this out. These are different methods. Another way to sample it is take the whole entire market and say at 7 o'clock in the morning, how far does it move on average? That's called time slicing. So you go from 7 a.m. to 7 a.m. to 7 a.m. to 7 a.m. That's what time slicing is. And if you take event slicing, how far did it move every time we got a stochastic? So we're just rolling back in time. That's what this represents. We're saying find this pattern, this bullish pullback pattern, go back in time, find every pattern, and then go forward in time and figure out how far it moves. This is a technology that I developed to determine how far things move. Now, really though, the main crux of this, just to get the structure in here, and then to have a massive lecture about the structure. Well, those were the last few that I was almost done on that I didn't get to put in. I finished them off. The thing that we need to cover, though, is this. This is a sizing spreadsheet. Anything in green, you input. This is your target range modifier, your target stop range modifier, your share range modifier, and the number of losses in a row. And what this is used for, we have one goal. How do I overcome a loss? Once I take a loss, how do I overcome it? Well, and how do I size? So there's really two equations built into this spreadsheet. To understand something in here, I have to make one little simple drawing, and I'll put it into the notes in there. It has to do with a balancing of your real need for money versus your real need for loss in a row, okay? And it's something you have to think about, because to size correctly, you not only have to know how far it's going to move, but you have to take into account this. And if you don't, you're foolish. You just won't trade successfully. And every person is different, what I've learned over my career. They have total different risk tolerances based on where they are in life, okay? It's just completely different. What you do is you take this right here, and this is a teeter-totter. On one end of this teeter-totter is real losses in a row, okay? Now, real loss is down here, and that's supposed to really be the delta sign. Real loss in a row. This is something we have to take into account versus what we call how much I must make. I must make. Well, I have to size to losses in a row, and that's the middle point. I have to do that. But if I size too small, because my account's too small, I won't trade because I won't make enough. This is a emotional problem. This is not a model problem. It's a total emotional problem with how we're set up, okay? So that's really important that we address this. It falls right under trade psychology, and we need to address this right away, okay? Let's go grab it over here. It didn't pop it up. Okay, we're just going to take copy, paste this in here, right-click, and I pasted it earlier today, so we're just going to have to let it, oops. All right, we will copy it here. Copy, edit, paste. Oh, well, it's nothing like insanity, retrying the same thing over and over again. We'll cut it. Now I know I have it. Oh, it'll only go in here. That's a Google thing. I did not know that. All right, so we got another way to fix it. I'm going to drag it right on over. We'll see if the drop and drag method works right there, and it does. It drug in there, I think. We'll just give it just a minute because it showed up later. This one showed up later on, or maybe it didn't. We'll save this right away. We'll save this and add it in, okay? We'll just call it a money management psychology. Trade psychology, okay? Because this is what we're really trying to address. How far is it going to move? And compared to our brain, what we can really deal with. Okay, I'm just going to save this on mine, and I'll bring it in just a second. Maybe I will do it this way. Okay, to get this all done. Okay, I just paused it while I figured out how to paste it into the document. And it went in there really nice. Now, what we need to calculate in here is how am I going to balance? What do I need to do? Really, let's take a step-by-step of money management. And I prefer flowcharts, so I'm going to put a flowchart up to do that, and then we'll put it in our document. Really, of sizing and money management. What am I going to do? Well, the first thing I need to do is what number freaks me out? What number freaks me out? Freaks me out. Now, there could be a couple of these. Usually, it's a number between how much you make per day versus how much you make per month. Okay, so if we go into the spreadsheet, you type in your monthly wage, and this will calculate out how much you make per day, and this will calculate out down here a percentage. That's what this line is. Looks like it's off. 1 second. We'll just delete that and bring these cells up because we were adjusting it. Okay, this right here shows you a percentage of your monthly income that you're risking, okay, at any one time. Well, that's 2%. That's one thing you have to deal with. Another thing down here that you have to deal with is losses in a row. And I'm going to set up a new tab in here. Okay, let's just go down here. We're going to put in a new insert a sheet. And we're just going to come in here. We're going to say 1, 2, 3, 4, 5. And all this is going to represent is losses. Okay, this is just going to represent losses. Not in a row necessarily, but just losses. Okay, now up here, we're going to calculate in 100, and we're going to take this 100, and we're going to divide it by a loss. It would take 100 trades to wipe me out at 1% loss. Okay, now down here, if I risk 1% of my account, 100 trades wipes me out. If I risk 2%, it takes 50 trades. Okay, if I trade 8%, it'll only take 12 trades to wipe me out. As a rule of thumb, 99% of the technicians I talk to will not ever size beyond 5% risk for any series of trades or one trade. They just won't, because their risk of ruin is too high. This is actually called a risk of ruin calculation, and it's too high. So we'll call this risk of ruin. Okay, now these we don't need. I'm going to delete this sheet right here. I'll delete it later. You're not going to need that down there. Okay, let's just get the sizing right here. So when you come in here, the first thing you do is you type in your wages per month, and this is going to calculate out your daily wage. And this is to help you find out your kind of freak out number, or you never go over 5% risk. Now, anything in green you could fill out. This green right here, this says that, hey, I want to take 14 losses in a row and only lose 1% of my account. I want to take 5 losses in a row and only lose 1% of my account. I want to take 1 loss in a row and only lose 1% of my account. Well, what this does is you come back over here and you pick now the size of your account and what 1 tick equals. This is what 1 tick equals is 1 cent. Okay. You just type that in, whether it's 1 cent or whatever. All right, 1 tick, it's the minimum fluctuation in the spreadsheet. You don't even, matter of fact, I'll take this out, and the spreadsheet will make it so that you can't even change this. You won't want to touch that section. All right, so it's 1 tick. Now, if I come down in here, this is your ATR per day, and this right here is the number of shares that you're going to trade, and this is your distance to stop and distance to target. Okay, you pick these. Which brings up the second problem. How do you tell where to put your stop? Well, stops revolve around volatility. They have nothing to do with sizing right now. Nothing to do with sizing at all. So stops have to do with how far something moves. So we laid out some possible sheets in here, and we said, you know what? I'm going to risk, I want to be in an S&P trade for a long time, and I'm going to use like a Bollinger Band buy. I'm going to use something like... let's take an RSI. I'm going to go up here and I'm going to attach something. I showed you this today, and we're going to pop up an RSI buy. Okay, we're going to bring in here relative strength right here, and it'll say relative strength. You're outside your Bollinger Band, and this is green means that we have a possible trade, and then it triggers. Okay, if I take a Bollinger Band between here and here, and I say that's my stop, and I got triggered in, so I'm going to take it from where I got triggered in. Let's say I got triggered in at the high of the bar. That would be my stop. If I got in over here, okay, and I said, well, this is current volatility, let's put my stop back here. Okay, I got in right here. I didn't even use my stop that much. All right, now here I got in, but it didn't drop back all the way. So let's take it from the low. I got stopped out, maybe right there. Okay, maybe, because we're saying that we got in at the high of the bar. That's our stop, and I might have got stopped out before it came down. All right, and I definitely did over here. If I came down and said, you know what, this is the distance between my Bollinger Band right here. Here's where I got triggered in at the high of this bar. Did it drop below it? Yes, I would have taken a loss. And that would have been a stop. I took 1, but that stop kept me in 1, 2, 3. It kept me in most trades, all right? Most trades, because stops have to be a function of volatility. They cannot be a function of anything else. Now, this one in this strong uptrend, you would have had massive failures of your system. Look, here's your stop right here. Here's your stop. Okay, we're going to move this up. There's your stop. Did we get stopped out before we went to the bottom of the band? We're assuming the bottom of the band's our target. Yep, got stopped out there. Okay, oh, I got another one in here where I went across the band. I'm looking for it to get across the band. And this is where I got in at right there. That's my stop. I got stopped out again. Okay, that didn't work. But it just kept trending up. This was a strong uptrending stock at this time, the SPY. And we use that. It's much easier to pick a bottom than a top. It's much, much easier. So the model would have failed right through there. But regardless, when you start to analyze a stop and you come down here under trade sizing, really volatility is what it is. It is what it is. Granted, a little range, a narrow range can lead to a big range, and a big range can lead to a narrow range. I mean, this is just a side note on here. And we can adjust. We can say side note, little ranges. A range is defined as resistance minus support. A little range is leads to a big range, leads to big range, and big range leads to little range. Okay, big range leads to little range, leads to little range. But most of the stops, all these techniques just measure volatility. So one of my favorite stopping mechanisms is to build an HV box. Now I'll show you what an HV box is. This shows you a really good example of what we're talking about. I'm going to bring in a tool right here, and I'm going to drop this tool on, and I'm going to say, computer, calculate out some information for me right at this time. And it probably won't update on this one. This one's a static, what's called a static chart. It's a backtesting chart. It may not update on that, but we'll see. I might have to load a different chart. I will. So we'll grab it right here. We'll pop this on. I'm going to grab, these are real charts. These are running. The other one, it's static. It doesn't have any way to launch its application. So we're going to come down here, and we're going to bring this up, and we're going to talk about right here, how far does it move? Because we need to know this to get into a model. All right. I'm going to say, computer, show me all this information on how far it's going to move. Okay, and I'm just going to click OK. Now, it's going to go back in time, and it says out of the 2,000 events tested, 1,900 of them support formed next. It followed down this path. It said it came down 6 ticks and then rallied. Okay, and it rallied 97% of the time. This is what happens. These boxes represent a 1.5 standard deviation box. So most of the turning points will happen in the bottom box, and most will turn in the top box. This is telling you it's a good time to buy. All right, that's what the computer's saying. We're getting close to a bottom. It may jump right back up. Well, let's do our technical analysis. Yes, it's getting a good time to buy, but how does this affect our stops? 80. Well, 2 standard deviations, it's 13.6, 13.6, and 64.8. It's about 95% probability that we don't get below that line. That's at 2 standard deviations. So what I'm going to do is I'm going to redraw this whole thing at 2 standard deviations. And I'm going to say something. I'm going to say, you know what? I'm going to put my stop down here at 2 standard deviations. Okay? Now, this is going to go through here. Oops, I forgot to change the standard deviation setting again. This is just an example. Okay? I'm saying, you know what? Normally it won't come down here. So what I'm going to do is I'm going to grab this, and I'm going to pull this on. I'm going to pull it all the way to the bottom. And I'm going to say, let's look at standard deviation of 2. Okay? So 95% of the time, I'm not going to get stopped out, am I? No, not at all. Most of the data is contained in that box. That's stop. Here's the average. Here's the average. So really, it's double average. And that's a good thing to notice. it's a quick calculation. Usually a double on average would give you the stop. So you'd say, oh, look, it's not going to go down there. Now, if I took a Bollinger Band and I said, well, let's check out a Bollinger Band and how far does it move? Okay, and I throw this Bollinger Band on there. Well, that's a really narrow band right there. That's a really narrow band, but that only works off of so many bars backwards in time. It's going, well, it goes back 20 bars. Well, maybe the 20 bars doesn't have anything to do with what's going to happen on the next 20 bars. Those are different techniques I can get into with you about how to size. Okay, so right now we're just going to say A, pick a technique. So let's put up our flow chart. We were going to do this. What size freaks me out? You need to know that. Note it and pick a HV assessment, or how far is the damn thing going to move? How far is the damn thing going to move? Damn thing going to move. You have to tell me this. You're going to fix it out. Okay, so you're going to take assessment. Okay. All right. Hold on just a second. Okay, so the first thing, you got to know what number freaks me out. This number is some percentage of wages, some percent of wages for most people, percent of wages. Okay, now the next one down is how far does the damn thing move? Well, we can put this in. This is a technique you pick. Okay, you're going to pick some kind of HV technique off your spreadsheet, off your modeling system. So pick a technique. Now, I have my favorite ones, but you pick a technique and you say, find a technique. How far will it move? Pick a technique. Pick technique. Well, okay, this is going to tell you how far it's going to move. Now, you know what number freaks me out. The next thing you're going to have to do is pick really, how many losses do you think you'll take? How many losses will you take? Now, there's several ways to get this. Will you take in a row? Now, the first thing you're going to do to figure out losses in a row is you're going to pop in here, and you guys don't have to do this, but you could know from your model. So I'm going to bring up a model, and I'm just going to say, computer, find me a model. And this is a model. It's a pretty simple one. It's not taking a lot of trades. This one took 35 trades. Now, it didn't take a lot of picks, but these are models, and I'm going to take out the zero models. These were no trades. It's a really picky model. It said, you know what? There was no trades in here, so we're going to disregard that. And then it'll show you using this model. I don't even know what it's tested. There were 28 trades right here. This is an equistochastic crossover, and it was done on the S&P. This was optimized, but we're going to plot on this, and we're going to say this. You know what? I would like to view this report. Let's go back to one of these. I wanted to view it, didn't want to plot it. Let's just pick one and view. Okay. This tells me in back testing, this is what this is used for. It comes down and tells me how many losses in a row. So the average loss dollar, but consecutive losses are 8, no 5. This is important because you need to size to consecutive losses in a row. Because if you come in here and you say, all right, I'm going to look at my spreadsheet. Now let's finish this. The spreadsheet, these are consecutive losses in a row, 14, 5, or 1. This is the amount of wages you made last month. This is the value of your account. This is where you want to put your stop. Now, where did the stop come from and your target come from? It came out of your volatility assessment. You type those in there and you say, okay. Now, without even touching this middle thing, I'm going to change all this stuff to 1, and we're going to come back and talk about this in a minute. Okay? We'll bring this back and talk about this in a minute. Okay? Now, what we're going to do is the first column is the percentage of your wages. Well, you'll be down 2% of monthly wages. You'll be down 40% of your daily wage at 1 loss in a row if your target's $2 and your stop loss range is $2. This is pennies. It's the minimum fluctuation. Okay? Dollars per tick just means that every time it goes up, you're going to win or lose $1. Don't worry about this column. I should probably hide it. Your share size is 100 shares. Okay? This is a ratio of something. I'll show you. This is used for something different in a second. I'll explain those two columns in just a second. Your loss at one stop, because you have 200 shares, you're buying 100 shares right here. You're risking $2 stop. You will be down $200. Well, you're going to take a cumulative loss of 200, then 400, then 600, then 800, then 1,000, and we're just going to keep, if we took consecutively 5 losses in a row. So at 5 losses in a row, we're toast. We're down $800. We didn't want to be down $800. That's 8% of our account. It breaks our risk rules. We can't do that. We can't take 5 losses in a row, or we can't start and have that big of size. So what controls our size then is we say, well, wait, I only want to be down 1% at 5 losses in a row. Well, this is 125 shares I need then. So I'm going to go to 125. Well, now when I lose 5 times in a row, I'm going to be down close to $500. Okay, that's 4 times in a row. It's going to land right in between there someplace because of slippage. You'll be close, but you'll be down, $500 to $600 right in that area. Now, that tells you how many losses in a row is going to affect you, but that doesn't get us to the second problem. So our first problems that we bump into are really trade psychology. Let's actually put this in a new sheet. I was thinking about the best way to do it. I'm going to save this one, but I'm going to bring up a new sheet, okay? A new document, and we're going to say trade psychology. Trade psychology. We're balancing all these factors: trade psychology, trade size, and money management, trade management. Now, each one of these has a different goal. And the trade management systems, they are set up really. They're going to be set up to help you identify or help you overcome your losses. That's something that's really important. How am I going to get over this loss? Okay, so I've got to cover all this. How am I going to overcome the loss? And how am I going to overcome? This is what we're going to want to cover Monday. So here's the main topics we're covering: trade psychology, trade size, and trade management. So look, trade psychology is I cannot lose more than X, or I am upset. Okay. Trade size deals with this. It deals with how far does it move? How far does it move? They're called volatility stops. How far does it move? Volatility stop. Now this has nothing to do with the above section up there. This is really important. Okay, so you have volatility stops, and this other trade size section of it is how much do I have to make? How much do I have to make to feel good? Okay, to feel good. Now, if we come down here and we go down to trade management, how do I fix a loss? How do I fix a loss? Well, really what we have to do is we have to size to losses in a row, okay? So when we go to do this trade sizing, we need to figure out how far it's going to move, and then we need to make sure that we don't exceed our freak out number and how many losses in a row. Well, this is where the spreadsheet comes in. So once again, we put in your wages, your starting account value, the distance to target, distance to stop. This came out of a technique that you find. You input this. Everything in green you input. The number of shares is really coming from the number of picks that you pick over here. You're going to pick something over there, and you'd say, well, I want 200 shares. Okay, you come over there, and you look at it, and maybe I will have to take a quick peek at this. Hold on. Oh, I thought I had an error. These don't calculate unless you've changed this line right here will not calculate. It's linked to these lines unless you started to change some of these money management profiles. So that's why I paused it for a second. So this one, it's pretty straightforward. If you just take the 200 and you risk 200, 200, 200, 200, 200, 200 for 5 trades in a row, you lose 200, you win 200, you lose 200, you win 200. That's really straightforward. what happens, this is the most important section, this middle section right here. When we get into trade management, there's only so many things that you can do, okay? And one of them is you can increase target. These are your only variables, and we're going to put these in your notes. I'm going to put a vocabulary note up here, okay? We're going to put vocabulary. Okay, now the vocabulary notes up here, we're going to come in and we're going to say we have T equals target, okay? We're going to make a variable that says S equals stop, okay? L equals size, okay? Don't ask me why. L is just going to equal size. Okay, so we can change our target, our stop, and our size. Size revolves around account, okay, or money. Target revolves around HV, okay, and S revolves around just what's called Brownian motion, how close I can get to the stop. Brownian motion, okay, it's how close I can put my stop. There's a limit to it. Brownian motion. All right, so if I come down in here and I want to look at this and I want to say, hey, I'm trying to figure out where to put my stop. All right, now I'm going to lower the font on this. It's a little bit too big. I'm just going to drop it down from 34 to like 16 or 14. Let's make it 14. Okay, so if I come in here, how do I fix this loss? Well, I can use these variables, T, L, and S. L and S. Let's put them on the same line. T, L, and S. All right. So I'm going to give you an example of how T, L, and S work. Just normal things. One lot or one share. No, 100 shares. Let's do this. 100 shares times $1 target. $1 target. $1 target. Equals the same as, let's go to $2 target. Okay, it's going to equal 200 bucks. $200. All right. This would be the same as saying 200 shares times a $1 target. Okay. This is going to equal $200. Now, this means that we can factor in any of these and slightly change them. Now, here is what we're going to have to work on when we get together, and this is the main learning objective. Okay, so at 3:32 or 32:43 in the video, okay, video, I'm going to put this in here, notes. Main learning objective is covered at 33 minutes.